In this video, we're going to be talking about ETFs, what they are, how they work, and how they differ from mutual funds. Hey YouTube, today is going to be an in-depth explanation of what ETFs are and exactly how they work. Everyone's talking about them, but not everyone knows exactly what they are or how they work, so we're going to be diving deep into that today. If you're one of those people that's a little bit unsure, don't be alarmed, we're going to remedy that situation today. If you've liked the content so far, please do us a big favor, hit the like button and subscribe, and we'll give you some more awesome content going into the future. So what exactly is an exchange-traded fund? An exchange-traded fund is a type of security that includes a collection of securities, such as stocks. They often track an underlying index. They can invest in any number of industry sectors or use various strategies. ETFs are in many ways similar to a mutual fund. They are listed on exchanges, and ETFs are shares traded through the day just like any other stock. Okay, so that's the exact definition from Investopedia, but we're going to break that down a little bit and go into it in quite a bit more detail. Okay, so an ETF is called an exchange-traded fund because it's traded on the exchange, just like any other stock. I find that if you say it backwards, it helps you to understand a little bit easier, as in, a fund that is traded on the exchange. I imagine ETFs to be the love child between a mutual fund and a stock. An ETF's price will go up and down through the day, just like any other stock, although they are comprised of a multitude of different securities. It could be stocks, bonds, other ETFs even. This is unlike a mutual fund where they're only traded once per day in the after hours. An ETF can own hundreds or thousands of different securities through multiple different industries, or it could be isolated to just one industry or sector. And even though they might only be restricted to one sector or one industry, they're still quite diverse in that they have obviously quite a few companies within that sector, and that's really attractive to people who really want to diversify their portfolio. Some of these funds only focus on the Australian offerings, and some are global ETFs. One example in particular is the Shares Global Etf. Ticker symbol is capital I, capital O, capital O. And it's focused on the S&P Global 100. That means that it's focused on tracking the top 100 companies in the world. Now, some of these companies are things like Apple, Microsoft, Alphabet, which is Google, just to name a few. ETFs provide a much lower average cost, since it would be very, very expensive for investors to just go ahead and buy an ASX 200 ETF. If you went and bought every single company in that ASX 200, the brokerage fees would be quite a lot. Whereas if you were to buy an ETF, you'd own a slither of each of those companies in the ASX 200, but you've only had to pay one brokerage fee for it. You only need to execute one transaction or one brokerage fee to buy the ETF that is comprised of all those 200 companies, and you only need to pay one transaction fee to sell it. Extremely cost effective. And with the ETFs, you have something called the expense ratio, and the expense ratio is the ratio that it costs to run the fund. Generally, they're very low because ETFs are generally just tracking other indexes. All it has to do is say, look at this index and say, what are these companies? Okay, I'm going to put them in my own portfolio. If that's all it has to do, obviously it's not time consuming as well. You don't have to have a professional to do that, to really dive into each individual stock and pick those stocks. That makes the operation cost of managing that fund extremely low, and you reap the rewards for that. Okay, not every single ETF tracks an index in a passive manner. There are some active ETFs, and you will have to pay a higher premium for those in terms of the expense ratio. So just keep an eye on that, because if you're a long-term investor, those high fees can really hurt your bottom line. Something as little as 1% can make a difference of hundreds of thousands in the long term. All right, so we're going to go through a couple of the little pros and cons, with ETFs. Honestly, there's not a lot of cons, but I'm going to try and give you a few. We'll see how we go. Okay, so pro number one is access to many stocks in many industries. Okay, so that means Diversification. Yeah, everyone says, well, most well-regarded investors will say diversify, diversify, diversify. ETFs are already diversified. You don't need to go and pick your own stocks from different sectors in order to protect yourself with diversification. Okay, so lower expense ratios. It doesn't cost as much to manage these funds. Like I said before, they're tracking other indexes. All the work's been done. They copycat those funds, and we're allowed to buy them. Simple as that. And with that comes lower brokerage commission. So instead of having to buy each of those stocks individually, you buy the ETF portfolio, and they've already purchased all those stocks. But to do that, in doing that, you only have to purchase the portfolio once. Okay, so pro number 3 is risk management through diversification, which we already went through that in pro number 1. But I've written it down here as its own pro, so there it is. Risk management through diversification. Okay, so pro number 4, there are ETFs that are around that only focus on specific industries. Okay, so if you don't want to invest in every single industry, that's fine. You can invest in particular industries that are in your circle of competence. If you don't understand the financial industry, you don't have to invest in that. You can invest in the healthcare industry if that's what you understand, if that's what you know, if that's what you're comfortable with. Yeah, so you can choose different ETFs that are invested in different industries. It'll suit your portfolio perfectly. So yeah, there's another pro for you. Okay, so pro number 5 is that they're extremely liquid ETFs, far more liquid than a mutual fund. If you wanted to sell your ETF shares tomorrow, you can do it easily. Not to say that you couldn't go and sell your mutual fund shares tomorrow, but there are different circumstances that might hinder that process. Okay, so let's go on to the cons. Actively managed ETFs have higher fees. That's a con. I don't know of too many actively managed ETFs. There are some out there, so just be aware of exactly what you're investing in. Obviously, make sure you do the right research and speak to a financial advisor if you can, before you go and dive into something like stocks or ETFs. I said before that you can invest into ETFs that are focused on individual industries. That's really good, but it can also be bad as well, which can limit your diversification across your profile or portfolio, sorry. And that's all the cons I've got for today. I actually highly rate ETFs. I think they're a really, really good investment tool. Maybe I'm a little bit biased. I can't see too much wrong with them. Okay, ladies and gents, that brings us to the end of our ETF session for today. I hope it's clarified ETFs for you a little bit. Please leave a comment in the comment section below and let me know what you thought or what you might want to see next, and we'll do our best to get that for you. If you liked the content today, please hit the like button, hit the subscribe button, and we'll see you next time. Cheers, guys.